I was just getting situated. Patience is a virtue.
Okay, so cash I'm going to say is $100,000. AR, $200,000. PP&E, I'm going to call it $1 million. Accum, I'm going to say, oh, let's call it 400. Land, let's see, 6, 9. That should be getting me to $1 million, right? And then I'm going to say AP 25, FMBO 75, 1, 2, 3. Oops. And then I'm going to say and that should get me there. Equity. Let's see. Okay. Total. Okay. Okay, it's all the same, right? I'm good. Okay, so I think we all know, well, let me ask. Kelsey, there's two categories of transaction which result in 754.
Redemption and death.
Redemption and death. Redemption and death.
Is that right?
Partially, but it just made me giggle a little bit. Redemption and death. I mean, I think I'm getting a little tired. Noodles, how you feel about redemption and death?
Love it.
Is there any possibility that you could expand and make it more complete? Because you're not wrong. It's just not complete.
I would say like transfer of units between partners or sale and exchange of units. What?
Brad, how you feel about that?
Could be better.
How would you say it?
If someone buys your partnership interest,
Okay. And?
if you pass away, and then it'll have a step up, or yeah.
Okay. And there's another one. Because who's the someone if someone buys your units?
An outside person,
Now, okay, but there's another party that could buy them too.
someone else in the partnership already.
Okay, and then there's another one on top of that,
The partnership itself.
the partnership itself. Okay, so the two categories I was shooting for was redemption and cross purchase. Okay. So the cross purchase actually could be captured in a subset by death. That's why I was kind of giggling.
Okay.
And you said it with such zeal. So cross purchase and death. We'll just leave it at that. Okay, and how you interact with that when you have a cross purchase or death is kind of the key. All right, so I'm going to say that this is, well, let's back up. I'm going to say that we have a cross purchase on this tab. Purchase whereby C sells to D for $1 million. Okay, is that a redemption or a cross purchase?
Cross purchase.
It's a cross purchase. Okay. So before we start this, let's go back to, our normal or stuff we've been talking about. That, what's proceeds?
Cash, property, debt relief.
Cash, debt, property relief. Oh, it's right here. Okay. And what's our accounting equation?
Assets equals liabilities plus equity.
And do you think those are going to be helpful in doing 754, Kelsey?
Yes.
It is. Okay. So, if I have a balance sheet of cash, AR, equity, in a very simple way, of 100, 100, and 200, and somebody comes in and says, I want to buy your business for 1,000. Okay? Your starting point is proceeds, is it not? So, do I have any debt relief here?
No.
Okay. So I'm going to buy it for 1,000. So my proceeds is 1,000. My debt relief is 0. My property is 0 for a total amount of 1,000. Then I compare it to basis. Correct? How much is my basis?
200.
200. Now embedded in that 200, have you made any assumptions in making that assessment at all, or should you ask additional questions?
Additional questions.
What are the additional questions?
As far as like your basis goes?
Yeah.
Do you have any like 704B issues, C issues?
Okay, that would be for a gain allocation, 100%. That would be a great question. Not what I was shooting for, but that is a good question. But I'm specifically asking, is that a good assumption? Is 200 a good assumption? Or should we do anything to diagnose whether that's correct or not? And what is it that we should ask to figure out if that's correct? What if I said,
Fair market value?
nope. What if I said, that was a balance sheet that was given to you by Sam Addy, and it was GAAP basis,
What are your tax adjustments?
or their tax adjustments? So anytime you're dealing with 754, you got to keep in mind, you got to get to tax basis. So you got to ask yourself, is this on tax basis or not? Then you're going to have to diagnose whether it is or not. And going back to what JP said the first day, how he said, I break things down into its most small part and put it back together. That's what you have to do here. Okay? So we have a partner-to-partner transaction whereby C sells to D for $1 million. Okay? So if that were the case, where do we always start? Let's start with fair value first and figure that out. And then we'll worry about tax basis in just a second. How do we figure out fair value in terms of the assets?
Start with your equity section.
Okay, and how do I populate the equity section?
Well, they're all, it was $1 million, right?
Yep,
So we can assume that C's portion is worth $1 million, and if he owns a third, then everyone else also gets $1 million. So total equity would be $3 million.
okay. So, then where do we go, Kels?
Your debt.
Okay, so debt would be being assumed, to the extent debt's being assumed, correct?
Yep.
So now we have 3.1 of assets equals, liabilities plus equity, correct?
Yep.
So my balance sheet side has to be equal to what?
3.1.
Okay? 3.1. So now, going back to the purchase price allocation we talked about earlier, correct? We now have to allocate that 3.1 million in and among all the assets. Okay? So we're going to now assume that gap equals fair value with the plug going to
Goodwill.
goodwill. Okay? So what would be the fair value of my cash?
100,000.
Okay? What about my AR?
200,000.
What about the PP&E?
$1 million. A cum of 400,000 and land of 100.
Okay? So, or said differently, this could be just plain 600, right? So, my plug, hold on. Was, yeah. Plus, minus, sum. $2.1. Okay? So if we actually sold the business at a 100% clip, we would have 2.1 million of goodwill. So this is GAAP. Come on. This is fair market value. And how did you interpolate that fair market value?
Start with equity.
And you populated it with first what you knew about C, right?
Yep.
And then you put the rest in, you populated the rest based on what proportionality to what C's equity interest was. Then you added debt, then you got to the asset side, and then you allocated that cost in among the assets. Correct?
Yep.
Okay. So I am now going to push this aside for 1 second. Okay, I'm gonna give myself a couple more. Okay, so we got a fair market value balance sheet now, right?
Mm-hmm.
So, and this is a couple different ways of doing this. There's more than one way to skin this cat, and I'm just choosing a path. So, what if I told you this hurt? That we still have the same million. Okay. Do we have an adjustment?
Yes.
And what, in addition, what if I told you we were cash basis?
We would have an adjustment for AR.
Okay, so the way I do this, the way I personally do this, is now I'm analyzing the balance sheet. I got cash. Is there any adjustment that I need to make to cash to get it to the right value? Is there any amount that I need to adjust to AR to get it to tax basis?
Yes.
Okay, so I think of it in this in entry format. And when you go back to that work that I did for standard, did you see columns with entries? I'm addressing each line on that balance sheet to say, is this right to get to tax basis, or is it wrong? And if it's wrong, I now have to adjust that asset to get it to tax basis. So is AR right or wrong?
It's wrong.
Okay. So now I'm thinking of entries. So I have to eliminate that, don't I?
Yep.
So now I'm going to come up here and say, adjust for cash basis. And I'm gonna come here and where's my wrap? Is this wrap? This?
Down one. You have to click on the arrow.
This?
No.
There's
Go to-
ABC, just to the right.
To the right.
This.
Yes, that one.
Yep.
Yeah.
That's what I said. And you guys made fun of me. It was hurtful. Oh, all right. Okay, so Kelsey, is AP also a cash basis?
Yes.
Okay. So I'm gonna come up here and put this across. Okay. Then I'm gonna come down here and put this across. Okay, so, and then I'm gonna come here, and I always love to have my check figures. My total versus my total. Am I in balance? Am I in balance in that column? So where do you think the entry should go for this? The 175.
Would it be to your equity?
It would be my equity section because nobody's reported that income yet. Okay. So now PP&E is what? What's my net book value?
For tax, it should be 200,000.
Okay.
So you'll,
adjust PP&E to what?
to 200,000. So a $400,000 adjustment.
Okay. Where's that go?
Equity.
Okay, so now equity needs to be reduced by 400, correct?
Mm-hmm.
So are those the adjustments that we have to make?
Yes.
Okay, so now tax basis. Oops, what are you, come on. Oops. Okay, are we in balance?
Yep.
Okay, so now we started with Gap Financial. The first thing we did, right, wrong, or indifferent, and you can choose your ordering, I don't care, is we came to fair market value balance sheet. Then we recognized that the Gap Financial statement was not on tax basis, correct?
Yep.
Okay, so then we adjusted the Gap Financial to get tax basis, and then we have now we can track. I'll come back. From the top, we could start with Gap Financial, get to fair value, correct?
Mm-hmm.
And then once we get that, we also have to create a tax basis balance sheet or figure out if we have to do analysis whether we're on Gap or tax basis. And I do this via entry because this allows me to go, is this account good? Yes or no. Is this account good? Nope. Therefore, I have to make an entry. Is this account good? Nope. I have to make an entry. Is my land good? Yep. So now I'm on tax basis. I created my fair value, and now I'm able to Control C, V, V. Okay. So, does this feel, just out of curiosity, ow, motherfucker, does this feel remotely at all like a little bit of the stuff we did with 704C and 704B? Is this a skill set that you can carry over from that to be able to execute on this? I mean, it's not exactly the same, but when I said earlier, 704B and 704C have some similarities in terms of the tools you use and how you execute on it. There's similarities. Because we're now talking about tax basis balance sheet, we're talking about fair market value balance sheet. We now are looking for the inherent gain. God, does that sound exactly the same? It feels exactly the same. So, this is as if insert this is if 100% was sold, is it not?
Yes.
Oh fuck, that was close. But how much was sold, Kels?
A third.
A third. Oh, damn it. Okay. So, a third was sold. Okay, so if we come up here, how much sold? Correct?
Yep.
Percent. Do you think it's possible for us to now say 754 step up right here by saying plus this times this? Hold on, I want to come here, right? And then I want to go V, oops, C, well, why isn't that working? Control C, V. And who sold?
C.
So let's see if this works. Um, 100. And if I come up, where's my, this it? Nope, hold on. Control C. Oh, please work. What the? I'm having a lag here for some reason. Why isn't that working? Am I in balance?
Yep.
Okay, so step one of what we did was calculate the fair market value of the balance sheet. Right, wrong, or different. You don't have to start there. And my intuition is I don't start there. I start with tax basis, but who cares? It's not a bad place to start. Then step two, do an analysis of the GAAP financial to get it on tax basis. Okay, and this sheet here is partner to partner. Partner to partner in debt. Okay? So, at this point, we converted to tax basis, we converted to tax basis fair market value to find out where the gain loss is. Then we took the proportional amount that was sold. We figured out where the inherent, that took the proportional piece of their step up by asset. And there was 900,000 of step up. It'd probably be helpful if I did this, right? And yeah, I think I can leave that alone. There's 900,000 of step up. There's 66,000 of step up in the AR, 133,000 of step up in the PP&E, and 700,000 in goodwill. So now if we go back to the sale of our partnership interest, C sold their interest to D, correct? And C's gain in that sale, assuming no inside-outside basis difference, is how much? $891. Okay? But of that $891, how much of that is a hot asset? Sam? What's the definition of hot asset?
The hot assets are the cash basis AR, the depreciable assets, is that right?
Yep. And appreciated
And
inventory.
appreciated inventory.
And appreciated inventory. Does the existence of hot assets, of cash basis AR, depreciation recapture, and appreciated inventory exist on this balance sheet? Where?
AR.
And probably
And
we're going to say PP&E is 1245. So I'm just in the pursuit of being more precise, because Brett, words matter, right?
Right.
Why is that not? This thing's screwing with me. So we'll give you that piece of information. So $200,000 of that gain by C is going to be ordinary. And there's a correlation in between the step up we're taking on the balance sheet under the 754 and the hot asset that's being inflicted on C. Does everybody see that correlation? Brett, you see it?
Yes.
Okay. Leslie, you see it? Okay. So, let's talk about what happens here. Here's just kind of the calculation from a 50,000 foot view. Because again, I think if somebody came to you and said, hey, we see us selling their interest, can you do a hot or a 754 calculation? Can you articulate, Kelsey, the steps? Or no, Colin, somebody, I picked on you enough.
Brad.
Brad, what are the steps?
First would be get whatever their financials as of the date of the purchase or what transfer. And then we'll assume it's on GAAP basis. Then you have to think, okay, what I'd take a look at the M1 schedule to get an idea of what you think might be adjustments you need to adjust to get your balance sheet on tax basis.
Yep.
And then once that's calculated, I think it's always good to check the equity section to see if it kind of ties to the basis schedule.
Yes, that is a great comment. What did that mean, Leslie?
Could you repeat what you said?
In this example, I guess column E, once you're through that step, take a look at the tax basis schedule we put together for the return, and it better be really close or not exactly the same.
So, what you're saying, Brad, is once we get to column E, which is tax basis, correct? That assuming, and this is an awesome comment. I mean, this is dead on. This is worth hammering on. Is that we should be able to look at the basis schedule, which we all know what the basis schedule is, right? And that basis schedule for A, and that basis schedule for B, and that A basis schedule for C should say at the very end 108,333. And that 108,333 is likely not going to tie. In a perfect world, it's not going to tie to our basis schedule. And now Brad's saying, what's he talking about and why is he saying that? Well, do we always sell on December 31st, Brad?
No.
Do we always sell on January 1st?
Nope.
Is there activity that might be embedded in that balance sheet that you have to account for the current year activity?
Yeah.
And generally, do you have to update that basis schedule to account for that current year activity in order to get it into sync?
Yes.
You do. So the 100, unless we're selling on December 31st or we're selling on January 1st, you have to account for current year income, current year loss, and distributions to adjust the basis schedule that Lutz would have to hopefully tie out to that 108,333. So I would, you guys don't even have this page. I would say highlight this number and put a note in there because you don't have the benefit of this page. Sorry. Okay. Is there anything in here that we can highlight? Is there a balance sheet in here that we would want to make a note on? Okay.
Balance sheet?
Yep, balance sheet. Everybody got the balance sheet? So I would take and highlight on this page, the balance sheet page, the equity section, and put a post-it on there to say exactly what we just said. Once you get to tax basis, you should be able to take each person's basis in that equity section and tie it back to the Lutz basis schedule. And that is a good check figure to tell you that your tax basis balance sheet doesn't have a bust.
Wouldn't you be off by your cumulative permanent differences? Like, let's say we're jamming 100 grand of meals and entertainment through the M1 each year, right? Because that would be showing on our.
I don't think so.
Yeah, no, you're right. Never mind. Because if it starts with GAAP, it'd be in there. Yeah. I was thinking just a book that wasn't GAAP.
So that's a really good check figure. So if your equity section ties out to your basis schedule, then you feel pretty good that your tax basis balance sheet is pretty solid because you now have a check figure. That's a great comment. Okay, so keep going because now you were on your.
So now that we have the tax basis, balance sheet, we need to look at, populate the fair market value, balance sheet.
And how do you do that? Where do you start?
Start with equity by taking whatever was purchased, in this case, $1 million for 33% interest. So we know the enterprise value is $3 million.
Yep.
And then go along. A debt's usually a good place to start.
Yep.
Most of that's going to be the same, except for maybe AP, like in this case. And then go to what you know that doesn't really change from GAAP purposes, and then adjust for PP&E's common. Might have to set a value for the fair value if you know that or not.
So what you just said is you took your equity section, got to fair value equity, added your liabilities to get to one side of your balance sheet, which is your liabilities plus equity. You populated your assets total, and then your asset total you allocated in among your assets. You felt pretty good that your GAAP AR was equal to fair value, your cash was equal to cash. PP&E, we had presumed it was book value earlier in terms of value, but that is something that could be negotiated up or down and plugged to goodwill.
Correct.
Okay? So then what happened?
Then we calculate what our gain or loss on each individual asset or liability. And that's for the whole entire company. And then after that, you see how much you sold of your units percentage wise and take a portion of that gain or loss towards, and that'll be your step up.
Okay. So who bought C's units?
D.
D bought C's units. So if the only activity that occurred in the given year for the next year, the only activity was the collection of cash basis AR, how much income is reported at the entity level without worrying about
200.
200 because we collected it? Okay? How much of that 200 is going to go to D on his K1? Just, you can do this proportional. You don't have to give me a specific number.
1/3 of 200.
1/3 of 200. Okay? And 1/3 of 200 happens to be how much?
667.
Okay? So he's going to get an income item of 66,667, right?
Yep.
But he also, specific to D, who purchased the interest, has a 754 adjustment, which is going to offset that income and protect him from that because he got the step up. Correct?
Correct.
Okay, so we would file with the tax return, a statement that says D purchased C's interest. When D purchased C's interest, D paid $1 million plus D assumed whatever that proportionality is for the liabilities, which is 8,000 for the 25,000, and it would be 24,000 for the First National Bank. So you still have that proceeds versus debt, and then you'd have the basis number that would be on there, and you'd come to a gain ultimately of 891 on the total schedule. So you'd have cash. The schedule is cash, debt, property, same way we normally do. What's the basis? Come up to a gain of 891, and then the schedule says, okay, now you break out that 891 into its different components, and you say AR was 66, PP&E was 133, goodwill was 700, and that tells the IRS which piece, how you allocated that gain in among the assets. That's how you do it. Okay? So, stupid question. This was my GAAP balance sheet, correct?
Is that the balance sheet as of the date of transfer?
Yep.
Okay. So if he purchased it in June 30th, we would need a balance sheet and
As of
fair
June
market value out of, okay,
And then you'd have to adjust your base schedule up or down
yep,
for whatever the current year activity was.
okay.
Okay, so who bought what?
D bought C's interest.
D bought C's interest. Is there anything that happened to that GAAP balance sheet? Did any asset leave the building? Did any asset get contributed? Did anything happen to that balance sheet?
No.
It did not. So the only entry that's going to occur with respect to that balance sheet is you're going to say, well, we have equity in C. Well, now you would debit C's equity and credit D's equity on this tax basis balance sheet, and that's it. It's a name change. That's the only thing that happens. Okay? So, What am I looking for here? Why don't I see it? Oh, yeah, there she is. Move to then, create a copy. I'm gonna blow all this stuff out here for a second. Delete. I'll blow this out. I'll blow this out. So those are the same. Okay. And I'm going to change my fact pattern to say that this is $1 million, or 10 million, that's always good. And I'm going to change this to be 975. My footing. I'm going to change this. Partnership redeems C for $1 million. Okay, I'm going to turn this off for a second. Home. Turn that off for a second. I'm going to take this. Let's see. Let's do this. Let's see if this works. Okay, I'm going to leave that alone for a second. Okay, so partnership redeems C for $1 million. Okay. So, stupid question. Do we still have to get the partnership balance sheet on tax basis?
Yes?
Yeah. So is this exactly the same as the other procedure? So, if I come over here, plus then I do this, it's going to be all the same, right?
Mm-hmm.
And then Control C, V, V. It's all the same, right? We still have to be on cash basis. Okay? So, I didn't make a huge deal out of the previous transaction, but what happened last transaction? Who bought what? Brad?
D-bot C.
D bought C. In this case, we're having a redemption. And to me, a redemption is a little bit easier to wrap your head around, kind of, because you actually have an impact on the balance sheet of the entity. So how much do we redeem? Hold on. I need this. I'm going to delete these. Delete. Hold on, I didn't want to do that. I want to do this first. No. Yeah, let's redo that for a second because I want to make a point. Copy. Okay. Let's do this because it's going to be insert. Insert. Copy. Numbers. I'm going to use this as a guidepost because it's not always this easy. Or generally, we treat it as something easier. Okay? So let's not worry about this over here for just a second. Okay, I put that there as a guidepost as we progress. So, in this case, Alyssa, who's buying the interest?
Partnerships buying the interest
Partnership.
from C.
And are we using somebody's assets or are we using partnership assets?
Partnership.
We're using partnership assets. So if we think in terms of just debits and credits, is my cash increasing or decreasing by virtue of this transaction?
Increasing?
My cash is increasing?
Decreasing?
It's decreasing?
I don't know.
Oh, on, damn it. Is it increasing or decreasing? Ask somebody as I'm fiddling.
Sam, what do you think? Leslie?
So the partnership is paying out the cash, so it's decreasing, right? Because they're paying the partner that's leaving.
Correct. So, entry to exiting partner. So you're saying that's leaving the building, right? Who is exiting the building? C. So do you suppose that C's capital is also going to go away? Okay. Does that number look familiar at all? It does. Okay. So when the partnership is having the person exit the building, we're using partnership assets. And we're using partnership assets. A and B are disproportionately giving the cash to the exiting partner, and we're pushing aside 751 and what we learned about distributions earlier. So this, just think in terms of entries. The partnership no longer has cash, correct? Or it's reducing its cash for the exiting partner. So it's a debit to cash, credit to cash to the amount that's going out. Then C's equity, or the retiring partner or exiting partner's equity, is going to go away. So we eliminate that. So let's go back over the steps. Step one is we eliminate, or we get a balance sheet on tax basis, right, Brad?
Correct.
Okay. Then, once we know that, we know that we've negotiated with C how much we're going to take them out for. We negotiated $1 million. So on the tax basis balance sheet, now we're dealing in entries. We're going to credit cash for $1 million because that's what we negotiated. We know C is going to go away, so we have to eliminate C's equity out of the balance sheet. So that's going to be a credit cash for $1 million, a debit to equity for $108,000 because that's his tax basis equity. Entries have to be in balance. We're accountants. They have to be in balance. Am I in balance? I'm not. So now the question is, where's the debit go? So I came over here and I populated with a tax basis balance sheet at 100%, and I populated a fair market value balance sheet at 100%, and I have inherent gain. And I know that how much was sold or redeemed?
The third.
A third. So does this look familiar to what we did before? on, the other calculation? So here's my entry. Which is going to be, let's say this is entry. We'll come back to that. So we know the PP&E, we should have a debit on a PP&E of that, of 66. We know we have a step up in my PP&E of that. And I know in goodwill, I have a step up of that. And I know that I assumed cash basis AR of that. Am I in balance? So when it comes to redemption, you have to get to a tax basis balance sheet. You have to still do the full tax basis versus fair market value to figure out where your inherent gain pops out. You still have to take that times a percentage, because step one, tax basis balance sheet. Now we're going to use partnership assets to redeem out the partner. Debit or credit cash for the amount that we're sending them out. Debit equity for retiring their equity. And now I got this disparity, correct? So since I have that disparity, I now have to focus in on what was, on a global basis, where was the gains? Where were they? Take that global gain times the percentage, and that's going to be informative of how to populate the remainder of that entry to get back in balance. So, at the end of the day, this balance sheet, which has 66,000 of AR, basis and AR, $700,000 worth of goodwill, who do you think enjoys the write-off of the goodwill? Sam? A and B. Because A and B took a disproportionate amount of their assets, the cash, and gave it to C on the way out the door. Okay? So, stupid question. Cash of 500,000, AR of 100,000. Liabilities, FNBO, First National Bank, of, let's see. I'm going to change this for a second. I'm going to get this side first. I'm going to say of 100. And I'm going to go with A, B, and C equity of 200, 200, and 200 for a total of 600 in equity, 700 on this side of the balance sheet, which would, I'll go 600 cash. Does that get me there? 700? Okay. What is my step up in basis if the partnership redeems out C for the 600,000 and gap equals tax? What's my step up? And what's it go to?
Goodwill.
Goodwill. Well, let's see how you feel about that.
Kind of following, maybe.
Kind of what?
Kind of following.
Kind of following? So what?
Yeah,
what
do you have
the
to-
what's the steps?
Well, do you have to back off the 100 for AR?
Do
Or
what?
to back off the 100,000 for AR?
What do you mean back it off?
No, because he said gap is equal to tax.
Oh, okay.
So what's the steps?
Okay.
Anybody?
Fair market value balance sheet.
Okay. So what's my fair market value balance sheet?
Start with equity.
Okay. My equity is what?
Well, C got 600,000 for his 30%. So then you can infer that the total is 1.8 million. My math is right.
Okay. Then what?
And then or your liability is the same, so 100,000.
Okay. Then what?
And then your cash and AR,
Hold on.
or cash is 0.
You gotta say that you correlate those two, right?
Yep.
And then what?
And then your cash is 0.
Well, on fair market value.
No,
Okay.
600,000.
Okay.
AR is 100,000. And then you plug the rest to Goodwill.
And how much is that?
1.2 million.
Yep.
Okay. Then what?
And then you multiply that times your 33% to get your, no, you take the difference between the two.
Okay. Inherent gain.
Yep.
What's my inherent gain?
0 for cash,
0.
0 for AR,
0.
1.2 for Goodwill,
Okay.
0 for debt, and then 400 each for Goodwill or for equity.
Okay. Okay.
And then you take that times the 33% to get your step up. Or to get your, yeah.
Okay. So what's your balance sheet when the dust settles?
Cash is 0, AR is 100.
Yep.
You have Goodwill of 1.2. And then, no? Yes? No. Goodwill is 0.
Uh-oh, now we got Tourette's approaching.
Yep. 400.
400.
Yep. Liabilities of 100. And then A and B have equity of, let me do the math, of the 1.2 million. No. Yes?
Okay, so let's start from the top.
Okay.
You're saying my ending balance sheet. Let's do this together, Kelsey,
Okay.
and take the trip together. Cash is how much?
0.
0.
Yep.
AR is
100.
100. Goodwill was
400.
400.
And we only do the 400 because there was only a 33% step up because that was C's proportion.
Yes.
Okay.
Total
500.
500. Then what?
Liabilities for 100. And then A and B's equity would each be 200.
Fuck. Does that make some semblance of sense at all? So when Adam Austin gives you a 754 calculation, you guys are going to be able to do this? No? Sam says no. Hey,
I've just never done one before.
Adam,
Mhm.
she's your first pick.
Yeah, all right, noted. So I think sometimes, like you asked the question to Adam, what's the adjustment? And he said 400. Don't you think sometimes people just say, oh, it's 400, and they don't go through this process?
All the time. All the time.
Do you have a template out there that, I mean, people should do this because sometimes that quick answer isn't always the right answer. Do you have a template out there that seem like you always say, well, each one's different, but it seemed like it'd be helpful to have kind of a starter template to that with the columns that people can modify.
Adam Pfeiffer put a good 743 template out there. And 743 is what, Alyssa? Sam?
One of the two. We didn't.
One of the two?
We didn't
Brett?
go over that today.
No. No, we didn't.
Partner,
Brett?
partner, partner.
Partner to partner. He has a good partner to partner template out there, which is a little bit, it's a really good version of what this was.
So if somebody wanted that, where do they get it? Call Adam? Seem like there'd be some,
He has that out there from, I
Repository for
think-
these things.
Do what?
There should be a repository for these things, like what's the SharePoint thing or whatever?
it's a good word. Yeah, I like that. That was
Repository
Feels like.
Was that commentary on training there, Kenny? Is that what that was? Anybody catch that but me?
I God, Mike,
I
I
got
get it.
Anyway,
It would be a good
that seems like
idea.
the kind of stuff that ought to be funneled into that SharePoint or whatever it's called.
Well, normally if somebody has something like this, they're probably gonna call you or Pfeiffer or somebody and say, hey, how do I get started on this? I would hope. Maybe not.
But the 743, we don't. The 743 he put together was pretty good. I mean, it's good. The thing about
From a calculation perspective, what would make it any different than a 734 template? Why couldn't you use it under both situations?
what do I start with? Cash.
Well, are you saying his template takes you all the way to the ending balance sheet also? Because otherwise,
his doesn't allow for the reduction of assets that are being used to distribute out to the partner. Because the 743.
yeah, okay, yeah. It does not take it to that step.
It
And
does
you're
not.
saying a 734 template in your mind would take you to the
Has
ending
to.
balance sheet.
Has to, because you have disappearing assets because they're being distributed to the exiting partner or the redeemed partner. So his.
But at least his template would get you what the adjustment is and where it goes under either of the two scenarios.
Should.
Yeah.
Well, no, because cash disappears.
But cash is going to be,
It might be
well,
later.
for
This
fair
is
market
one of
value
those
and basis,
moments where your
you're never gonna have a 754 adjustment related to cash.
But if you start with the equity section of, maybe it does work.
I don't see why it wouldn't unless a partner was being bought out with the distribution
maybe it
of
does work.
property. If
And
they
see,
were, if they
I-
were being bought out for a distribution of an asset,
It
a
would be
tangible
possible.
asset, then it wouldn't work, but
But this is where I say Adam Austin.
shortcuts the shit out of things, I think is the phrase you used the other day.
You do. But when he does, and they go, well, wait a minute, that doesn't work. His hit rate on it working is generally pretty good. But I have to work my way through it because I don't trust it. And not because it's Adam Austin or any other person. I just can't see it. And if I can't see it, then I can't say yes or no. If I don't understand it, you're not going to get a yes out of me. Is that fair, Kenny?
Yep.
I mean, if I can't wrap my head around it and I don't know what's going on, I'm not a big let's take a guided tour because I'm doing myself a disservice and you a disservice by just nodding. So when you go, you do your shortcut.
I don't think it's a shortcut. You're just stopping short of the complete final answer, but you're getting to your
No.
adjustment.
Like when we were doing the Outlook thing,
Yeah.
you did a great job of challenging my assessment and challenging how I thought the transaction should be cast, because that was a weird, funky transaction from a moving part perspective. But there were shortcuts in there that I had to work my way through, that you go from A to Z, and I needed to go through each piece to either confirm or deny whether I agreed with what your conclusion was. So you really had two things that were going in that transaction from us negotiating how we should reflect that on the return. But and actually,
What's an example of that?
what? The shortcutting?
Yeah, I don't remember that.
I don't know. I just felt like it was there. I might be lying. And I could be. But it feels like there
You're
were.
probably right. To me, you see the steps significantly faster than all the rest of us.
Well, but you use your gut to go, there's Z.
Okay.
You know, but you in general, it's generally pretty good. You know, and I do. I hold Adam out as a good example of somebody that has shown up and his knowledge base in terms of how to confront a transaction and work his way through a transaction was, when he got here, based on some of the things we've done as a group and talked about, was worse than the people in the room. Would you agree with that?
I would not disagree with that.
And you're not offended.
No. Well, because it's not stuff that I ever did before coming here. It's
100%.
if you're not doing this stuff fairly regularly, if you do it once, it's not going to stick.
But
I
Adam
was
has-
doing it less than once.
Adam has ground through 8 different things with me,
Oh,
ish, and some of them have had some challenges. You know, Dominic's stuff has challenges to it. The sale by Ron of 2 different entities with 2 different purchase prices, one being an S corp, one being a C corp.
went through. Yeah, that was.
Yeah.
Took about 3 years.
Outlook, our friend Gaines, you know, he's had multiple repetitions. And those repetitions, really, when we sat down on this Outlook deal, I'm telling you, it was weird because they had one seller on the sell side, but the funds flow had 2 sellers on how they dealt with
Closing costs.
and proceeds on some level.
Yeah, I would argue that funds flow made no sense. I think
100%.
what you're calling a shortcut was me trying to make sense of a funds flow that we were given that made no sense.
But it took a long time to figure out that it didn't make sense
Yeah.
on top of it. And then we had to get Tara in the room, and then we had to go back to the attorney, and then we had to go back to whoever.
Another attorney.
Oh. Oh, no, in my head I went to Kugler.
Oh, yeah, that's another good example though.
Yeah. Yeah. That is actually one of my favorite lines I've ever said to a client. Was he was doing a deal with somebody, and I looked at him and I said, okay, here's what has to happen. You have to repeat back to me that I, Pete, think what you're doing is catastrophically stupid. I did. I 100% said that. I need you to repeat that back because when this goes sideways, you are not going to be able to look at me and say that I didn't say it. And here's the reasons why I think this is catastrophically stupid. And he respected and understood why I was saying it was catastrophically stupid. And then I said, help me understand why you are doing this, because this doesn't make sense. And he gave me his business reasons. And his business reason, which overrode my catastrophically stupid assessment, my assessment that was catastrophically stupid, was, look, if I stick in this deal, I'm only going to be able to sell maybe for 1 time's revenue, maybe. If I get into this deal, I'm bolting on to other similar businesses or other same businesses, and we're going to roll this up into a much bigger thing, and I'm going to be able to sell out in a much bigger number. And on top of it, I get to keep half my cash flow or EBITDA off my specific business that I'm contributing. All right, fair enough. But you need to understand, I think this is catastrophically stupid.
From a tax perspective.
Economic.
From an overall perspective. And it's all come true, I think.
And unfortunately, I was right. I mean, unfortunately, I was right. So, but that was one of my favorite lines. You need to repeat back to me that this is catastrophically stupid. I needed to be that frank with him. And he understood why I said it. And that call that you guys witnessed with that law firm, you would have loved to be on the call with Trower Greenberg Trower. Do you know the firm, Kenny? I mean, they're big.
Not familiar with it.
Related to him?
Yeah.
Well, that was, you and Dana were doing that. That was before I got involved in it.
Do you remember the guy who was yelling at me and he was referring to the attorney?
Yeah, the carrot guy. Yeah. And I remember, yes, I know what you're talking about.
And during that call, our client kind of was saying, well, the attorney says that this is going to work.
Mm-hmm.
And I said, that's not what this agreement says. And we call the attorney, and the attorney just blathers on for about 5 minutes with nonsense. And I said, okay, let me get this straight. Are you giving legal advice to the people on the call? No. Let me be clear. I'm not representing anybody. So now again, let me get this straight, client. You are relying on legal advice from somebody that's not giving you legal advice to hang your hat on to file this lawsuit. That's what you're doing. Yeah, that's what I'm doing. All right. Now we're on catastrophic, dumb number 2. And did I say that?
Something to that effect. Yeah, the guy was basically saying like, well, yeah, I agree. That's not what the language of the agreement says, but our intent was this, and we all know that. So
Yeah, everybody.
That was
even including the guy that we're going to sue. It's all good.
I haven't heard any more on that, but
What client was this?
this is Lance Cooler Vision
Oh,
sold his
yeah.
practice at Physician Equity
Yeah.
Holdings is the name of this.
And he's a smart guy.
But he's also, I think he's attracted to the latest, brightest, shiny object that catches his eye. He's done.
He's not fly by the seat of his
No, he's
pants.
not. You know, he's very.
He's very measured, very smart. Okay. Do you guys want to talk about 754 anymore, or do you want to go home?
I got a couple questions for you.
Okay. Are they real?
No, they're real.
Okay.
Unless you want some,
You just have a look about it.
unless you have some, I could ask some not real questions.
I think I'd be more interested in those.
You're doing this, you're doing this fair market value balance sheet. Once you go through one of these transactions, a lot of these balance sheets we do aren't on fair market value. Or they're not on tax basis. So what do you normally do on the balance sheets going forward? You usually book this on the balance sheet, not book it, have an off-balance sheet entry.
Are you talking about after you go through the process?
Yeah, after you've done this whole spreadsheet, all the numbers tie, you've done your deal.
Well, on a 734, it's on balance sheet. Because again, you have to go through the process of depleting cash and then
Is that true for Gap?
If you got a gap balance sheet,
It's going all the way on the left. I was gonna ask you this question too. Going all the way over to the left
yeah.
on the, yeah. There,
It's not gonna be on the gap balance sheet.
so what is the entry for Gap? I hate to admit,
It's gonna be credit cash, debit equity. They have
and with the
no-
excess, you're eating away at everybody else's equity? Yeah, that's what I thought. Okay.
Yes. Gap has no concept whatsoever of individualized partner capital. So Gap is just gonna take out, or they're gonna reduce equity for distribution in that case. So you do have to track it. Fair enough. But if you have a tax basis balance sheet, and which we don't, but in both cases, you would have a work paper. You should have a set of work papers that tracks the 754 and its runoff in the over the next 5, 7, 15 years, depending on what you're dealing with.
and a lot of it, you know, if it's PP&E or goodwill, that just kind of flushes through on a M1 amortization, depreciation M1, with, accounts receivable. Would you flush that through on a M1 the next year?
If it's entity level,
Yeah,
I would, because everybody's going to share in it
Yeah.
equally.
but that could get missed easily, don't you think?
Could. It can. You know, so part of this is making sure that we're diligent enough, having the right information in the work papers. You know, and I've gone as far as to, if I'm paranoid, you know, in, who's that guy I fired? What was that guy? Yeah, him.
Is he still in the accounting profession? Oh, a client you fired.
Yeah.
Oh, I thought you meant an employee.
No, I've never fired an
Oh,
employee.
you haven't?
No. How many employees have you fired, Kenny?
Several, unfortunately. I got the short end of the straw.
No, I've never had that pleasure at all. And now we have another thing I don't want to ever have to do before now when I retire.
Can you scroll down to that equity? I just want to see what that entry is. Okay.
So, I mean, I've gone as far as writing in the work papers, bring this point forward, dear staff person, bring this point forward, deal with this point forward in the work papers next year. If you miss it, I'm going to be mad. If it's not next year's work papers, I'm going to kill you. I've never said that, but I mean, I've actually put some notes in there saying, and it has said, dear staff person, this is a very important work paper, and why.
Yeah, my concern is you go through all this work, first year, you get everything right, and then after that, something gets lost. I mean, you gotta have the right trail, make sure it's documented. So otherwise, you might have somebody new on it next year or 2 years, or you might be gone, and when, hopefully you retire one day, and then this comes up and nobody knows.
Yeah, so the most likely one that's going to slip through is a basis step up in land, basis step up. What were the three categories, Sam, for 704? What were the three, not basis, what were the three categories of assets for 704?
Oh, short-term recognizable,
Short-term recognizable,
depreciable assets,
depreciable,
and things sold in the future.
things sold in the future. So the short term on the AR probably not going to get missed. I mean, the likelihood is reduced in my view on that. Depreciation is probably going to populate on the depreciation schedules of 754, and that's probably not going to get missed. I mean, it might have an error, but the likelihood it gets missed.
If we put it on depreciation schedule, we should.
Yes.
Yeah.
And if it's a 734, it's just going to be 754 step up because everybody's going to be enjoying that equally.
Yeah.
But if it's 734, excuse me, 743, you got to tack it to, going back to my example, C sold his interest to D. Well, you'd have a 754 associated with D on that depreciation schedule to take that specific portion of depreciation and give that to D as a special allocation, right? And then the long-lived assets, maybe you put a memo item on there that says 754 land on the depreciation schedule.
Ideally, you should.
Yeah. What's your other question or questions?
That was it. They were kind of combined there.
Okay. Yeah.
I have one.
Yeah.
How do you get out of a 754 election?
Ask the Treasury Secretary.
It's not like a private letter ruling process, or, I mean, what does
I've
that,
never
what
seen
does that
anybody
mean?
try to get out, but I think it's by consent of the Treasury Secretary.
Isn't it if you make the election once, you have to keep making it?
No, it's once made, always made. So it's made in perpetuity. Once you open the door and make the 754 election, it's once made, always made. So this is something that's worth saying, and maybe it was in the material somewhere, but there's 734D and 743D. And do you know what those are, Kenny?
No.
No, he does not. But when I say it, he'll know what I'm talking about. That if there's more than a $250,000 inherent loss, okay, so I'm going to take a step back. 754 means you adjust basis of the assets to reflect the purchase of a partnership interest. We can all agree on that definition? So this is always presumed that there's appreciation in the asset and there's a step up. If somebody sells a partnership interest at a loss, then there could be a step down. And that step down, if a 754 election is made, you have to step down the basis of the assets of the partnership in the same manner that you step them up under a 754. So it used to be you'd have to really give some good consideration as to whether there'd ever be a possibility you'd have a step down on the assets in the future on whether you'd make the 754. Then they legislated in 734D and 743D that said if there's $250,000 or more of inherent loss on the balance sheet of a partnership where a redemption occurs or a partner-to-partner transaction occurs, you don't have to have a 754. We're going to make you step down the asset. So $250,000, let me ask a question. Do you think to Adam Austin $250,000 is a material or immaterial number to his balance sheet?
Personal balance sheet?
Yeah, you notice it. Couch cushion money.
That would be material to some people in the room, yes?
Yeah.
But to most partnerships, 250,000 is a rounding error. So at the end of the day, it's almost, why wouldn't you make, given that rule, Leslie, that this $250,000, if it losses in excess of that, the downside of making the 754 election basically was terminated by that legislation because they're going to make you step it down anyway. Any other questions?
When you do the actual election, the 754 election, what do you, some people have a lot of detail and some people don't. Do you have a preference? How much detail you put in the actual tax return for disclosure?
I'm so far removed, Kenny, on what may or may not go in there. I don't know, honestly. I should.
So maybe the forms got a little more better outfitted to disclose some of that stuff in the last year or two, right?
Which form?
You always used, well, the question on Schedule B where you check the box, am I making the election or have I already made one and I'm making a current year adjustment?
Yeah.
And then our software is definitely set up.
For the state.
He's getting probably no better than I would to disclose the allocation and everything,
Yeah.
where you used to just like do a PDF attachment or whatever, right?
Yeah.
So I think there's a spot on there now. It says like, how much did you step it up
It-
to?
Yeah, you disclose the step up in total. and
That's exactly what I used to attach.
Yeah, but there's like an actual line instead of attachment now, I think, on the form. Where you
Okay.
like
original amount you've adjusted and remaining.
But ideally, you'd break it out in these buckets. I don't know if that requires the allocation or not. Does it ask for the allocation or just a gross number?
I think it, not the line that Stuthman's talking about, but there's another spot in the software that you input this detail, and I think it does have
I think you could
lines
do
for you to
line item.
input the detail.
Yeah.
It prints as a K1 footnote.
Yeah.
Yeah.
Good. It's a great question. I have no answers.
It's become a little more user friendly, or debatable on this.
So how about a non-real question?
I can't wait.
Why don't you tell the group some of the books that you have in your office and at Lutz?
What are you talking about?
Don't you still have some of your books from when you went to grad school that you
Yeah,
refer
they-
to periodically? Oh, you've talked about that?
Yeah, my grad school notes.
Even though it's 30 years old, 25 years old?
It's 85% stable. And every once in a while, let's see, Canfy had an attorney suggest a solution. And I went right back to MemoryWise 1995 to a particular book thinking we talked about it in the class. And I pulled it out, and within the past month and a half, I've actually referenced the book because I remember talking about it in class. 467 Step Rental Agreement.
Aren't you paranoid that that's been updated in the last 30 years? You're not catching it by using that as your reference?
But if
That's the way I would look at
if
it.
I use that solely as my reference point, then yeah. But if I have something in there that says, here's what the boundary was at that point, and I can remember what the hell it was talking about, and what my notes were, and then I go back and verify that it's still the same, yeah.
Do you ever read the code and regs just for pleasure on the weekends?
See, this is getting
No,
No, I do not. Any other questions?
No.
Anybody want to supplement with Kenny questions?
Well, I'm sure some people wonder, how do you know all these code sections, reg sections, revenue rulings? I mean, not everybody can.
Actually, the truth to that is in grad school, I memorized the shit out of this. And when I memorized the shit out of it, it stuck. And then after that, I was able to tack on other things I learned to that memorized database. That's how it happened. Any other questions?
No,
You think I just love code sections, don't you?
I think you do.
It's a good way to categorize. Anything else, Kenny?
I don't know that it is that good of a way to categorize. But
Well, hold on.
there's no logic to the number. It's like,
Well,
you're saying earlier today, you're saying, oh, that's 704, which is, or that's, I can't even remember what rev rulings you were rattling off that's related to code
96,
sections that's
95.
completely different. And it's like,
TT.
okay, why aren't they closer together?
Kelsey, what are my code sections for 351?
I have them right here.
What are they?
351. I don't know. I can tell you what they are. I don't know the numbers.
Okay, fine. What are they?
Debt in excess of basis.
Yeah,
Basis in stock received.
yeah.
Partnerships basis in
Corporations. That's
Yep.
okay.
corp. Going back and forth, that's tricky. Holding period,
Yeah,
depreciation.
yeah. I think that's got them all.
Pretty
There's
close.
2 holding periods.
Yeah. 12,
351,
12, 23,
357, 358, 362,
168, I-7.
168, I-7, 1220, 1223, 1 and 2.
Don't forget about 368, which kind of factors into 351 as a whole.
368, C.
What's your favorite code section?
Ooh, that's a good question.
What's my favorite
Yeah.
section?
280F.
I hate fucking 280F.
No, I saw that Mustang you bought recently. That's
Yeah.
that's
I
a,
hate-
that's
I
a
hate
280F.
Favorite code section? That's a weird question.
Cause the code literally starts like code 1 and then
Mhm.
Tax
Tax
rates.
rates.
Code 1 is tax rates.
Isn't that right?
I'm not a code guy.
Let's find out, Leslie. I think it is. I don't know. I hate the 500s. I hate the 800s. Oops. Tax imposed. I guess that's just giving them the right. Is it 11? What's tax rates? I don't know.
That's corporate tax.
Whatever.
Did we pass or do we have to come back next year?
Well, I think the only people that are going to be able to make that assessment is yourself and whoever's reviewing your stuff. But I think actually Mr. Kennedy probably was, and I'm sincere, I mean, watching that exchange on them talking about 704C and all the elements, that was pretty good.
No, very good. Very good.
I mean, in terms of, I mean, that retention is very good. And I think you actually, if you retain it, you're going to actually have tools to do this, and we'll see.
439, is that one of your favorite code sections?
439.
Something 39. 339, 239,
I have no idea what the hell you're talking about. 1239?
1239, that one.